So the first stock which I have been buying recently is not actually a stock but an ETF which I believe will be benefited by the interest rate cuts, which is also good for both income investors and growth investors, as it has 7% plus dividend yield and has the potential to deliver some 15% returns in near terms. Now this ETF is currently down about 25% from its all-time high of 28.20 Canadian dollars, which it hit in February 2022. And it's the Hamilton Canadian Bank ETF, ticker symbol HCAL. The reason for me buying this is very simple. We'll see few interest rate cuts by end of this year, and these cuts will boost the net interest margins for the banks, improving their net interest income, and most importantly, it would reduce their credit loss provisions, which is a positive catalyst for the banking sector. Additionally, Canadian banks are trading at a 15 to 20% discount compared to their historical price to book ratio. So if you are wondering how to position yourself to benefit from the potential interest rate cuts, consider Canadian banks, and to diversify within this sector, HCAL is an excellent option with its strong 7% dividend yield, and it's currently trading at around 21 Canadian dollars. Now the next stock is not a technology or IT stock, but it can greatly benefit from the AI boom. With the growth of AI, the demand for electricity will significantly increase, and the need for green energy will continue to rise to support this AI growth. So the next stock or company is one that's on my radar, and the company I believe could be major beneficiary of this trend is Brookfield Renewable Corporation, ticker symbol BEPC.TO. The anticipated rate cuts will definitely benefit utilities. I missed the opportunity to get into it when it was trading around 30 Canadian dollars, and now it's up around 40% in a month, trading at 43 Canadian dollars. Brookfield Renewables has a global presence in hydro, solar, wind and nuclear power generation. It offers a 4% plus dividend, which is definitely attractive for the income investors as well. I believe that the demand for green energy will increase in the future, and the top industry players like Brookfield will definitely benefit from it. Also, its PE and PB ratios are reasonable, and the company has a strong management. It's currently trading at around 43.5 Canadian dollars. I really hope to see some good correction in this stock so I can get into it and build my position at my target price. So the next stock I bought, about which I must be honest that I'm not sure how it will play out, but since I have made a good position, I'll mention it here and explain why I bought it. So the name of the company is MTY Food Group with the ticker symbol MTY.TO. It's down around 38% from its high of $70 in February 2023. For those who don't know, MTY Food Group is a leading franchisor in North American restaurant industry with a diverse portfolio of over 80 brands. You must have heard about some of them. Now its PE, PB and EV/EBITDA ratios are reasonable to buy at this price. As you can see, the trailing PE is around 10.45, PB is around 1.3 and EV/EBITDA is around 8.66. The part that's not very positive about this company is its high debt. The debt to equity ratio is around 154%. However, they do have a good free cash flow and they are actively reducing their debts. Also, I'm not aware if they have these debts at variable rate, but if they do, the upcoming rate cuts will definitely benefit them. Also, it's very likely that the consumer spending will grow when they'll have some pressure of their shoulder after those cuts. So yes, I have made some positions in MTY in May. So the next company is one I don't even remember how many times I have mentioned on this channel. I am fan of it and I accumulated some stocks of it in May while it was down a little bit. My personal favorite, it is ATD.to. The only thing I want to mention about this company and stock at this point is to try to increase your position whenever you get a dip in the stock. This is one of the best managed Canadian companies operating globally in multiple countries. Their business is diversified globally, which provides great security in terms of their business. The possibility of having global issues that affect this company is very low. So don't think twice when you see some good opportunities to buy more. You can watch other videos on this channel where I have explained more about this company. The next stock is Canadian Software and Services Company that provides enterprise software solutions, currently down around 24% from January 2024, offers a very well covered dividend of around 3.6%, and the company is Enghouse Systems Limited. Its ticker symbol is ENGH.to. The best point about this company is it has almost no debt compared to its total cash on hand of around $250 million, which is also reflected in a great debt to equity ratio of only 2% for a software company. The company also has a good free cash flow and in a good position to acquire small software companies to drive the growth. Currently, I have a small position and I'm planning to add more before the quarterly results on June 10th. So income investors as well as growth seeking investors can consider this company at these current valuations. The last stock is something in which I have a great confidence and have been accumulated recently. It was down 10% in a single day after the election results, making it a great opportunity. Even after that drop, it's already up a bit from my previous buy call in February 2024. This stock still has a significant potential for more gains. The name of the company is HDFC Bank Limited, ticker symbol HDB. It is currently trading around $55.5. It's the world's 8th largest bank by market cap and it's India's largest private sector bank by asset. And the most interesting part is that it's still trading at a discounted price. How? So historically, HDFC Bank has traded at an average price to book ratio of 3.2. Currently, it's trading at price to book ratio of approximately 2.3, and this indicates that the stock is undervalued relative to its historical performance. Not only PE, but its PE ratio has averaged around 20.7. Right now, the PE ratio is about 16.1. And this lower PE ratio suggests that the company's earnings has grown, but the stock is trading at a discount compared to its historical valuations. So as one of the India's leading private banks, HDFC Bank is well positioned to capitalize on any positive economic developments within India. So if you are looking for a relatively safe play with potential of getting a 10 to 15% return in a short term, then I feel HDFC Bank should be considered.